So we're doing this video today because I see all over YouTube a bunch of people who say one thing is good and another thing is bad. And that's simply not true. That way of thinking is focused on product over your goal. And I know one thing. I know that if you're considering cash value life insurance, you want to make sure you get this thing right. And we're here to help you do that. And we want you focused on your goal, not the product. Because there's gonna be more than one product that can accomplish your goal. And we're gonna show you that today. And you need to make sure you stay till the end because we're gonna be showing you that there's nuance here. So we had a client that came to us and wanted to safely grow cash inside a life insurance policy. They weren't quite sure how they wanted to use it, maybe leveraging it for real estate purposes, maybe using it for some kind of tax advantaged withdrawal later on into the future, all of which are things that we deal with on a daily basis. And they specifically asked to look at whole life insurance and index life insurance. And if you've watched this channel, you know that we typically talk a lot more about index life, and there's lots of reasons for that. But we are not anti-whole life. In fact, we love whole life for certain things. And as long as you understand how all these different products work, we believe that you can make a decision that's in your best interest. And so we're gonna go through the policies that we showed this particular client, the highs and lows, and ultimately kind of where we ended up. So the first one that we showed them was this Lafayette Life Insurance Company policy, their Patriot 2022. I gotta tell you, I like this policy. I think this is one of the best whole life insurance policies that are out there for building cash. And there's a couple things specifically that I really like about this policy. Number one, I really like that they're very explicit in their policy packet here that dividends are not guaranteed and that actual dividends could be higher or lower than what they're shown in this policy. And that should go without saying. A lot of people are out there talking about how dividends, they don't say that they're guaranteed, but they will conflate whole life insurance and the guarantees with the projected dividend. Now, there's a lot of people that don't conflate those two things, and I applaud them, but there are a lot of agents out there on TikTok doing shorts that conflate the guarantees with the current scale, and you just need to know that dividends are not guaranteed. There's no such thing as a guaranteed dividend in these policies. Dividends are actually a return of overpaid premium. Not many people talk about that. I also like that they're very clear about their loan provisions. You can see it right here, policy loans. You can take a policy loan at any time, and that loan is going to be subject to a variable interest rate loan, and they line it out right here. The minimum loan rate is 0%. The maximum loan rate is 8%. I'm a huge fan of transparency. I like that it's right there in plain English. You know that the loan rate is going to be 0 to 8%. I also like that in this policy loan provision, they do a good job of dispelling one of the biggest myths in the infinite banking world and the TikTokers that are out there. They say right here, interest that you pay to us is not credited to the cash value of the policy, and it does not increase the cash value of the policy. Why do I like this? The reason I like this is because that's how every single policy works, and yet they've bolded it, they've put it right here where you need to see it in the policy loan section, and it dispels one of the biggest myths that I hear time and time again, which is the reason you do infinite banking is so that you can pay yourself the interest and not pay it to the bank. And Lafayette Life, credit to them, they're like, hey guys, that's not how it works. Interest that you pay to us, Lafayette Life, is not credited to the cash value. I love that. I love that this Lafayette Life policy has the ability to add on term riders because it's going to make this policy cheaper. There aren't a ton of whole life insurance companies that do this well, and I think that Lafayette Life does do this well, and I like that. Most importantly is their paid up additions rider is pretty darn flexible for a whole life insurance company. Not only is it flexible, but we can really dial in the premiums with Lafayette Life. There are a lot of whole life companies out there where you can't really dial in the premiums, and even if you can, their paid up additions rider is not this flexible. So we've got a $19,000 paid up additions rider on this policy, paid for 20 years. And I love the language here. The minimum annual premium for this rider is $500 in the first year and $120 in each rider year thereafter. If the minimum annual premium for this rider is not paid in any rider year, no more premiums will be accepted for this rider. So what they're saying here is we're scheduled to pay the $19,000 paid up additions. If you don't pay 19, as long as you pay the minimum, you can keep that paid up additions rider on there. I like that. That's a really flexible policy provision for a whole life insurance company. Most of them do not operate that way. If you miss your paid up additions rider, they may give you 1 year, or maybe 2 years. Some of them will just say, if you miss it, it's gone. So this is way more flexible than the field that's out there. Lafayette Life is a super high rated company. I believe that they are doing the best job that they can. And as a whole life insurance company, I have absolutely zero bad things to say about them. However, that's not what's most important, because again, product is not most important. Your goal is what's most important. So let's just keep that in mind as we go through this exercise. So let's look at this policy. We've got a $25,000 premium for the first 10 years, and then we grade it down to $24,450. The reason that we did that is because we're going to compare this with another whole life company that doesn't quite have the same premium flexibility. And so Lafayette Life, basically we had them match what this other company was going to do. And really what I want to key in on, because this is not necessarily a tax-free retirement play, this is more of a build up a bank, build up a pile of cash inside a policy that can be accessed for all kinds of things. I really just want to compare the cash values. And so we're going to do like a year 10, year 20, year 30 cash value comparison of these three companies. I've spent more time on this Lafayette Life policy. We'll be quicker going through the others. So year 10, we've got $279,000 in cash. Year 20, $710,000 in cash. Year 30, $1 million in cash. Now this is on the current dividend scale. This is not the guarantee. The guarantee is to the left. So our guaranteed cash value in year 10 is $218,000. Our guaranteed cash value in year 20 is $474,000, and our guaranteed cash value in year 30 is $557,000. So these are good numbers. I have nothing more to say about those numbers other than to tell you what they are so that we can make the comparison going forward. Let's quickly talk about the second whole life policy that I want to go through, which is the OneAmerica Whole Life Select. Another great company, really good whole life insurance provider, primarily used in the infinite banking space, and a pretty decent competitor to the Lafayette policy that we just looked at. And there's some things in this policy that I also really appreciate. The first one is that dividend language that we already kind of talked about with Lafayette Life, but OneAmerica is even more specific. Dividends are a return of premium based on the company's year-by-year experience. And I just love that they're not calling it something that it's not, they're calling it what it is, a return of premium based on the company's year-by-year experience. And I like that. I feel like it's really transparent, and I applaud them for that. The biggest thing that I like about this OneAmerica policy is they have this indexed dividend crediting option rider, which is a weird rider name. Indexed dividend crediting option rider. Let me try to break it down simply. They give you the option to take your dividend and allocate some of it to kind of like an index life policy would operate. And if that index that you allocate to pays out, it increases your dividend. If that index doesn't pay out, your dividend is less because you chose to allocate some of your dividend towards this rider. You don't have to use it, but it is a way to get a little bit more out of a whole life insurance policy for a little bit more risk. Now, I'll be right up front. This is not a comparison of OneAmerica to Lafayette Life because that's not the point of this video. We are using this index dividend crediting option rider. We've got 100% of our dividend allocated to this rider, which is going to increase our dividends by 24%. On this illustration. So I don't want you to compare this OneAmerica to the Lafayette Life as an apples to apples comparison because it's not. We're simply showing the availability of this rider and we're utilizing it in this illustration. So I just want to make sure you are well aware of that. This OneAmerica policy is one of the only policies that has what's known as a loan protection rider. There are not very many whole life insurance companies that offer this as a rider, and they do, which I really like. If you make it to age 75 and your policy's been in force for 15 years, you are going to have this rider kick in if your policy is ever in danger of lapsing after age 75. I really like that. It makes sure that 1099s don't go out to you when you're, over 75 years old, which is an important thing. So let's talk about the values here. And the reason that this isn't an apples to apples comparison to Lafayette is because this is just a totally different design and it's a different product. And again, it's about your goals. It's not about the product. So this one comes with a much higher initial death benefit in order to get the same premium in. So the Lafayette Life policy started out at $436, which is going to be better if we want more cash. The OneAmerica policy is starting out a lot higher, 1.2 million. We got there primarily with a term insurance rider, similar to the Lafayette Life policy. So it is a cost-effective way to get there, but we're about 3x the death benefit right out of the gate. Again, we are using that limited pay 100% index allocation to their dividend indexing rider. So the dividends are higher here than what you would see in the Lafayette Life policy, which is the only reason that this OneAmerica policy is really able to kind of generate pretty close cash values at the year 10 mark. 266 in cash value versus 279. So we're about $13,000 less, but 3x the death benefit. The guarantee is 44. The guarantee over here was 218. So a huge difference there. Nope, I've missed it again. Total net cash value, 245. PUA cash value. I have to tell you, I don't love these illustrations because this is confusing. There's two cash values on the guaranteed side and they have a net column for us on the current side. So I don't love that. 201 plus 44, so it's 245. 245 in guaranteed cash value versus 218. So we actually have more cash value early in the OneAmerica policy. I don't see any other way to read that. Very confusing, by the way. Don't see any other way to read that. And we've got 1.7 million in guaranteed death benefit. So a huge delta there in terms of death benefit at 768 versus 1.7 and more cash value. On the current side though, we are lagging behind by about $13,000. At the year 20 mark, 1.4 million in death benefit, $681,000 in cash on the current side, 710 in cash, 1.4 in death benefit. So the Lafayette policy has caught up to the OneAmerica policy by the 20th year, both on the death benefit side, and it has more cash. In terms of our guaranteed cash, we're about 570,000 there between those two figures, and 1.2 versus 474 and $1 million. So the guaranteed values are better on the OneAmerica side. The current values, internal temp too high, allow it to cool. All right, so let's compare the year 20 cash values between the two policies on the guaranteed side. We've got $1 million in death benefit and 474 in cash with Lafayette. And in the year 20 here, we've got 1.2 million in death benefit and about 570, it looks like, in cash value on the guaranteed side. So it looks to me that the guarantees are better on the OneAmerica policy and you get more death benefit early. And the potential cash value is better on the Lafayette side because we're able to start with that lower death benefit, makes it a little bit more efficient and probably builds cash a little bit quicker. But again, the product doesn't matter. What matters are your goals. If you want a high death benefit, then you would gladly do the OneAmerica over the Lafayette policy because it can keep pace with Lafayette with 3x the initial death benefit. So again, what are your goals? Let's forget about the product for a second. Let's nail down your goals and figure out which product's gonna best meet those needs within your risk profile. Moving on to year 30, our OneAmerica policy in year 30 has $1 million in total cash value, $1.6 million in death benefit. Our Lafayette policy in year 30 is at $1 million and 1.4. Our guaranteed cash is 557. Our guaranteed cash on the OneAmerica is higher. It's about 740. So a lot more guaranteed cash here on the OneAmerica side than on the Lafayette side. The guaranteed cash side is not going to factor in that dividend option that we chose. And so, that's not reflected there. So if you want strong guarantees, the OneAmerica policy seems to have better guarantees with a higher initial death benefit. If you want the higher cash value, safer, then it looks like the Lafayette Life policy is going to be the better option over the OneAmerica. So again, it all comes down to your goals. One thing's not good and another's not bad. That doesn't exist in almost anything. And so it doesn't exist here either. There's lots of good options, but what is it that you want? What are you trying to do? That's what we got to figure out. So I told you I was going to show you a third option. This third option is going to be an index life insurance policy. Now, I took the time to make sure that this index life insurance policy had the same risk profile as the two whole life insurance policies. And I'm going to show you why I think this is a really good third option, even if you are looking for something that's lower risk, because again, this is going to be the same risk profile as the whole life insurance policy. So first things first, I do need to accurately mention that in this particular policy, this is an Allianz index life insurance policy, I do need to make sure that I point out there is one major difference that might actually make this a little bit less risky than the whole life insurance policies, and it's the loan provisions. So when we scroll down to the loan provisions, here's our indexing loan. This is known as a participating loan. This indexing loan is contractually guaranteed at 5% in all years. Contractually guaranteed at 5% in all years. When we go to our whole life insurance policies, we addressed their loan provisions, and we said that their loan provisions were flexible, and in fact, we highlighted it. So let's just go back there and read it one more time so everybody's on the same page. The minimum loan interest rate is 0%. This is for Lafayette. The maximum loan interest rate is 8%. So there is potentially more risk here on the life insurance piece, the loan piece, with the whole life insurance company that is not offering you a guaranteed rate. They are offering you a variable rate on the interest they are going to charge you. And OneAmerica is also similar. It's not one is not better and one is not worse. You just have to understand how they work. So let's find the loan rates on the OneAmerica policy. All right, so I can't find the loan provision in the OneAmerica whole life insurance illustration. That kind of frustrates me. I don't like it when that happens because if I can't find it, you can't find it. The reason I can't find it is because it's not in there. But the reason it's not in there is because we're not showing loans. So some companies do that. If you don't show loans, they don't tell you what the loan charge is. I happen to know what the loan charge is. It's currently 5.02%, and it's also variable, just like the Lafayette policy. It's variable pegged to the Moody's corporate bond yield, and it changes monthly. Although if you take a loan, it's locked in for that year. So those are the loan rates, and I just need to point that out because I told you that that this index life policy is the same risk profile, and yet now I'm telling you maybe it's not because these loan rates are guaranteed at 5% in all policy years. There's no variable here that we need to learn about or track, and so that makes me ask the question: is this actually less risky? It may be, but let's look at the values. All right, so here's our Allianz life insurance policy. That's basically the same risk profile as the two whole life insurance policies we just saw. $25,000 going in for the first 10 years, just like the other two, down to $24,450 for the next 10 years. Let's look at our current scenario values. So we're at $522 in death benefit, which is pretty close to the Lafayette design, which was at 4 and change, I believe, $436. You will notice that the cash value is lower, $10,000 versus $20,000. Versus in the OneAmerica policy, I think it was a little bit higher. No, it was lower, 17. So we're looking at the current side only right now. Let's look at year 10, $785 in death benefit, $280,000 in cash, $279 in cash, and $874 with Lafayette. And with the OneAmerica, year 10, we were at total cash value $266 and 1.7. So the OneAmerica is still winning the race on the death benefit. It's losing the race on cash value. The index life policy with the same risk profile is actually winning the race on cash value in year 10 at $280,000, $1,000, $750, somewhere in there more than the Lafayette Life policy. Now on the guarantee side, it's going to be a different story. We'll get to that in a second. We'll go through the current first. Year 20, $1.2 million in death benefit, $770,000 in cash. The Lafayette was at $710, so $60,000 more in cash. The OneAmerica was at $681. So again, way more cash value, same risk profile here on the indexed universal life insurance policy. And when we go to year 30, $1.2 million in cash, $1.4 million in death benefit. On the Lafayette policy, year 30, we were at $1 million in cash and 1.4, about $200,000 more in cash on the current side in year 30 than the Lafayette. In the OneAmerica policy, about $1 million and 1.6. So OneAmerica still winning the death benefit race, losing in the cash race to both the Lafayette and the Allianz life insurance policy. And this is why there's no such thing as good and bad. The point of this video is not me telling you that this policy is better than the other two, because it's not. It's different. It's going to do different things. It depends on your goals. So the guaranteed scenario, death benefit still $520. Our year 10 cash value is $201, quite a bit lower, I believe, than the guaranteed. Yeah, $218 with Lafayette, and a little bit better, $246 with the OneAmerica policy. So the index life policy on the guaranteed side falling behind, which is what we would expect. And year 20 is going to follow suit, $401. versus 474 versus 576. The OneAmerica guarantees are super strong. I'm impressed by that. And then year 30, guaranteed 371. Okay, so now we're going backwards, and this is again showing basically a 0% return every single year for 30 straight years in a row. 371 on the guaranteed side versus obviously going to be way more on the OneAmerica and the Lafayette. 557 Lafayette, and year 30, 743 for OneAmerica. Okay, so the index life insurance policy giving you quite a bit more in terms of currently assumed rates, 280, 770, and 1.2, $200,000 more than the other two options in year 30 on the current side, which is the current dividend scale on the Lafayette and the OneAmerica. So that's the comparison. But obviously it's lagging way behind on the guarantees because that's how it's designed. And yet the OneAmerica, lagging behind in cash on all three of these options, is giving us the best, most sustainable death benefit. And that all goes to say there's no such thing as one thing's bad and the other things are good. That's not how this world works in almost anything. And it doesn't work that way here. What's important is, what are your goals? If you want the most death benefit out of the gate as safe as you can get it, it's the OneAmerica policy. If you want the most cash value with the strongest guarantees, and you don't care about death benefit at all, well, then you're looking at the OneAmerica or the Lafayette Life, because they both have some play there. If you're looking at the highest current assumed rate with the least risk on taking your money out, it's the Allianz policy. And that's why there's no such thing as one thing's good and one thing's bad. And if you're dealing with a current agent who's telling you that whole life is good and index life is bad, or index life is good and whole life is bad, one's good and one's the devil, you've got the wrong agent and you need to get a new one because they don't know what they're talking about. And that's the whole point of this video. If you want to know what's right for you, you should reach out to us, book a discovery call with us, and we're going to start by talking about what your goals are. Once we figure out what your goals are, it's going to be our job to go find the best product for you and your risk profile. And we feel like if we do a good enough job educating you and giving you all the information that you need to make a decision, you can make the right decision for you, your goals, your family, and your finances. This is Matt Decker, Leveraged Wealth and Cash Value Life Insurance Reviews. Go to our website, leveragewm.com. You can book a meeting with us at the top of that page. We'd love to chat with you. Until then, take care, and hopefully this has been helpful.